Afternoon, everyone. Welcome to committee. The House Taxation Committee will please come to order. Looks like I didn't scare off everybody yesterday with a 2-hour hearing, but appreciate everybody being here. First rule of getting done on time is getting started on time, I guess. So we will open it right up for bill introductions. Do we have any bill introductions? Representative Kelly.
Thank you, Mr. Chair. I have a bill that I'd like to introduce, 21 RS 0664, and this is the First-Time Homebuyers Savings Account Act that we had last year, but work on it this year.
Very good. Committee, any questions? Any objection to the introduction of the bill? Seeing none, it is introduced. Thank you, Representative. Any further bill introductions? Seeing none, thank you, committee. We will move right into our first item of business, committee, as we are beginning to work our way through the many complex topics involved in decoupling from the federal tax code. We have several different things that we want to look at, several different things that we want to, pardon me, I need to turn off my computer. Okay, sorry if there was some feedback there, but we do want to start taking an in-depth look at all of the pieces of this puzzle to the decoupling code. And the first opportunity we have here today is a briefing from Scott Roberti and Brian Leisman from Ernst & Young, and they will be discussing some of the income tax modifications to the federal tax code and different items like that regarding decoupling. And gentlemen, I'm not sure who wants to take the lead on this. I have you both down. If you have that coordinated, we'll let you start.
Great. Thank you, Mr. Chairman. I hope you all can see and hear us well.
Yes, we are good. We can hear you loud and clear.
Great, fantastic. I apologize we couldn't be there in person. At some point, I'd love to get back to Topeka. So what we thought we'd do today, let me just start with quick introductions for everyone. I'm Scott Roberti. As the chairman said, my colleague and I work for Ernst & Young, and my responsibilities are assisting clients with state tax policy activity throughout the country. So I'm going to be here to sort of give a multi-state overview of what we're seeing with regard to how states have conformed or decoupled from the Tax Cuts and Jobs Act. Brian?
Yeah, thank you, Scott. So hopefully everyone could hear me. My name is Brian Leisman. I'm based out of our Kansas City office with Ernst & Young. And I'd like to start the discussion. I guess I'd like to clarify, everyone has the materials that we provided. Are those on screen or in hand?
Yes, we were provided with those materials.
Okay, so we will be walking through that deck. So teeing up the agenda, I just wanted to spend the first portion kind of going through the Kansas taxation of corporate income, how that works and why that becomes meaningful in terms of the decoupling provisions that Senate Bill 22 addresses. So on page 4 of that deck, this is just a quick overview of how Kansas taxes corporations. So Kansas, as do most states, they rely heavily upon the Internal Revenue Code in building up the tax base. Kansas has chosen to follow the Internal Revenue Code on a rolling basis, meaning any changes that occur within the federal government are automatically adopted unless specifically decoupled for Kansas corporation income tax purposes. So if we were to rewind and go back to December of 2017, then we clearly had the large Tax Cuts and Jobs Act bill. That was a massive base broadening exercise by the federal government in order to buy down the rate from 35 to 21%. A couple of the elements of that base broadening that appear in the bill are the business expense disallowance provision, as well as the new category of income called global intangible low tax income, which we will call just GILTI. So that's what happened back in December. There's been new activity this year because of the pandemic in March and December. Those provisions, because of the rolling basis, will automatically become part of the Kansas tax base. Kansas has what we call a domestic combination approach. So unless you operate within one legal entity, Kansas has chosen to basically combine the business and tax it as one. That became it's been that way for a number of years. The Kansas Supreme Court case that started this trend goes back to 1984, and the reason I bring it up is because it specifically stated that only U.S. corporations can be in the group, and that foreign members were not. The next bullet point on here, which I'll go over real quickly, is the concept of apportionment. There are no provisions within this bill that appear to change apportionment, but I'm just mentioning because that's how, for state purposes, the pool of income is divided amongst the states based on their factors. Kansas applies the three-factor method of doing so. All right, on page 6, I want to talk about dividends because dividends it's an important topic when we talk about what GILTI means. I don't want to get too far down the road, as Scott will give us an introduction of GILTI. But I think if we kind of cover what they mean. So let's think about the definition. So a dividend, by definition, is a distribution of either current or accumulated earnings and profits from a corporation to its shareholder. So in the example of a foreign corp that's owned by a U.S. corp, that foreign corp might declare a dividend, and then they, subsequent to that declaration, pay the dividend. And that payment can be through cash or other property. The point here is that there is an actual economic transaction, a transfer of value, albeit cash or something else, between two corporations.
Ken,
Yes.
do you mind if I interrupt? Is there a chance that you could share your screen that might be a little easier for us on committee to, if you have that possibility?
I'm on 2 monitors here, so I don't know which screen I'm sharing. Let me,
Hey, Brian, let me try to, why don't you talk and let me see if I can do it from my computer.
okay. Let me,
Do you have
I
it?
push share.
Yep, there you go.
Do we see it?
It's coming through. Yes.
Okay.
Thank
Yeah,
you.
please enter. Yep. So, yeah, so I'm on page 6. So I just went through the kind of the definition of the dividend. So when we get into the taxation of, they're taxed differently. So a domestic dividend is taxed, not at all. It gets a 100% exclusion or dividends received deduction. A foreign dividend, on the other hand, receives a 80% dividends received deduction, and that is by Kansas statute. So there is a difference there. I just wanted to point out. So moving on to page 7. So getting into other types of income. So, and this is relevant when we have the GILTI conversation. So again, I want to go back to a Supreme Court case in Kansas, and this one's now Morton Thiokol. So I had discussed that Pioneer set forth the principle that only U.S. corporations can be taxed. Now we get a little additional information from the court system. And what it says is that in addition to that, only dividend income from unitary foreign subs can be included in the tax base of these U.S. corporations. And it was very specific that other foreign income cannot be included. So we sort of have this conflict when we talk about this new GILTI category of, the statute seems to suggest taxable, case law seems to suggest not. So just wanted to present that out there, that there has been some precedent that this sort of income isn't taxable. On the last point I want to talk about is a provision in the Internal Revenue Code. It's called Section 78. And what that provision does is that it allows for a gross up mechanism. So when I pay foreign taxes to foreign country, I get a federal foreign tax credit. And to the extent that in order to make that operate correctly, I need to gross up my income. That basically is reversing the deduction I get. Otherwise, I would get a deduction plus a credit, an unintended consequence. So this is a mechanism that the federal government has put into play to undo that. And the reason I bring it up is because it is very similar to GILTI. It's this income inclusion. Its sole purpose is to create income for purposes of operating with the foreign tax credit, of which states do not have foreign tax credits. So we get into this sort of interesting situation, and we do have a example once we get through the GILTI conversation to kind of help illustrate that. So at this point, I think unless anyone on the committee has questions, I will hand it over to Scott to tee up the overview of GILTI.
Are there any questions? Seeing none, Scott, you could go ahead and continue.
Great, thanks. So thanks, Brian. So Brian sort of outlined at a very high level how Kansas taxes corporations. So what we thought we'd do now is sort of move into sort of the start of TCJA, sort of the parameters or pillars that drove it, and then talk a bit about, sort of the foreign regime side of it. So if we sort of go back sort of a bit of pre-TCJA, so why did Congress feel this need to enact, broad sweeping federal tax reform for the first time in, 30 plus years? Well, it was really a combination of a couple of factors. One was the U.S. had one of the highest corporate income tax rates at the time of 35%. And then secondly, it had this regime of taxing worldwide income. Especially when that income was brought back from overseas, or what we call onshoring. And this combination really, quite frankly, created what we call a lockout effect. And what that is companies that had multinational operations, and I'm on page 9 real quick here, that had multinational operations felt that it was easier or better for them from a financial perspective to keep those earnings, those foreign earnings overseas, and reinvest them, let's say in their manufacturing or production facilities, versus bringing that investment back to the U.S. and paying the high 35% rate. So how did we get there? So TCJ was enacted in 2017 with this concept of moving to what we call a more of a territorial system. But for Congress to get, from the old system to the new system, it really had to accomplish two things. First, it provided a transition and created what they call this transition tax, that provided companies a mechanism in which to onshore those foreign earnings back in 2017 and 2018. The second piece of it was, and Brian, you can move on to slide 10. The second piece of it is that Congress wanted to ensure that companies with U.S. operations paid some level of a minimum tax. And when they were thinking about this, they thought about it in a couple of different perspectives, but they ultimately sort of led themselves to this concept of global low tax and tangible income, this GILTI piece that we are going to talk about and define a bit more. So Brian, why don't we sort of dive in on the next page, on page 11, and let's sort of get into what GILTI is, and it's really a federal provision that was adopted as part of the Tax Cuts and Jobs Act, and as we indicated, sort of acts as this minimum tax. Prior to Congress adopting this or looking at this, they were actually considering a border tax. A tax on all imports into the U.S., assigning some level of a tax to those types of products. And they should have moved away from that over the concerns that it acted more like a tariff than a tax, and we're very concerned about some of the treaty implications as a result of that. So they decided to move in this direction. And there's a couple of elements that we need to think about, before we sort of get in and define GILTI. First of all, it's not economic income. It's really this minimum tax base that has an element of income earned in foreign countries in it. It also operates hand in hand with the federal foreign tax credit, which is a critical element as we move into this, and sort of a distinguishing factor as we compare the federal tax regime to state tax regimes. So if you look on slide 12, there's really sort of three key elements, and we promise not to get too tax technical here, but certainly happy to answer any questions or drill deeper as needed. So when we think about sort of that calculation that makes up guilty income and the deduction, there's really three main elements to it. The first is the base or foreign income inclusion, which is defined under 951A. The second element is this concept of a deduction. So Congress understood it didn't want to tax or create a minimum tax at the full rate, the new rate of 21%. It wanted to create a minimum tax at half of that. So to accomplish that, it provides for this deduction, this 50% deduction under Section 250. So you have your foreign base, and then you get this 50% deduction to get to this minimum rate of 10.5%. The third leg to this stool is the foreign tax credit, which we sort of briefly mentioned, and that is this concept: if this income is subject to tax in a foreign country, and the company pays that tax, as long as that rate is at a level, you should be able to deduct those taxes paid against any potential U.S. tax. So it avoids this concept of double taxation at a country level for the same income. And it's critical that all three pieces of that, so the three legs to that stool, are present in the federal calculation. So maybe to sort of better explain this, what we thought we'd do is maybe juxtapose an example with two sets of facts. And I'm going to let Brian walk through that. And then, obviously, if we get through that, there's additional questions on sort of that guilty calculation. Happy to answer those.
Yeah, thanks, Scott. So the example on page 13, so here we have a U.S. shareholder. It owns a controlled foreign corporation, or CFC. So we have a CFC that operates in a foreign country, and it has earned $150 of guilty income on a gross basis. So the 150 is the 951 Cap A provision. We are then allowed, as Scott mentioned, a 50% deduction against that income under Section 250. And the result is that we have a net guilty amount of $75. Now, foreign entity operating in foreign country pays foreign country taxes. So in this example, the tax rate in foreign country is 20%. So 20% of its $150 of income results in a foreign tax expense of $30. Now, when I was talking earlier about Section 78, this is when that comes into play. So because we have the foreign tax credit, we have to add that $30 into the calculation to avoid the double benefit. So we have, again, $75 of net guilty, $30 of gross up, resulting in federal taxable income of $105. So our now rate of 21% results in a tentative tax of 22. So I call it the tentative tax because we still need to apply the third component, which is the foreign tax credit. So that computation in its most simplest form is 80% of the 30%, or excuse me, the $30 of foreign taxes that this entity paid. So we have up to $24. So we only potentially owe 22. So we have capacity and can fully offset our income. So this example results in $0 of U.S. taxes paid on its guilty. Now, I don't have a slide, but I'm just going to change one fact. And that fact is the 20% country rate becomes 10. So if the 20% country rate becomes 10, I'm now paying $15 of foreign country tax instead of 30. When computing my foreign tax credit, 80% of 15 is 12. So now I only have up to $12 to offset my federal tax. So I'm now going to pay federal tax on guilty. So identical facts, but different results. And that's a very intentional outcome of how GILTI is supposed to work, because it's a minimum tax. You only pay it if the foreign country rate is so low that the US government says, hey, we're not comfortable you being that low, we want the difference. If it's 20%, okay. 10, that's too low. We're going to tax a portion of your income. All right. Moving on to the next one, now we're going to talk about the Kansas consequences. So going back to the original example of the 20% foreign country rate, we have federal income of $105. We have a gross up of 30. Now, Section 78, this is Section 78. So Kansas provides for a 100% deduction, as does, I believe, every state, to remove that from the tax base. So we now have Kansas taxable income of 75, which, as you might remember, is our original net GILTI. And then if we were the federal government, we'd apply a foreign tax credit. We don't have that in the states. We have the apportionment regime divided up. So now we apply apportionment, we apply a tax rate, and now we have the end result of Kansas tax on GILTI income. The illustration here are identical facts. We've just identified different apportionment factors to result in the significance of this tax. So if we go to example D, now our taxpayer has a 40% presence in Kansas, measured by property, payroll, and sales. So let's go back to the beginning of the facts. We have foreign entity that operates in a foreign country, earns $150 and pays $30 of foreign country tax. It pays $0 of US tax. It pays $2.10 of Kansas tax. That's not a logical outcome based on how we would expect the taxing system to work. And it's the result of adopting only 2 of the 3 elements of the GILTI calculation. We have the missing foreign tax credit piece. So states do not have foreign tax credits. So in order to correct this, which Scott will get to in a moment, the most common way is to provide for a subtraction modification to remove this GILTI income inclusion, which would be identical treatment to what all the states do with current Section 78. So I know that was a lot of facts. If we can, any questions on that before I think Scott takes us over to see how the states are reacting to this?
We do actually have one question, Representative Highland.
Thank you, Mr. Chairman. I'm looking at the current slide, and did you say the apportionment factor is based on their presence in Kansas? And did I hear you correctly that that's based on sales?
Property, payroll, and sales, the average of those 3 factors.
Say that again, please. I couldn't quite understand.
It's the average of the property, payroll, and sales.
Property, payroll, and sales.
So it's generally going to be, obviously, to the extent you have a physical presence, you have people and assets, which increases the tax. So you're causing in-state businesses to bear the brunt of the taxation.
Thank you, sir. Thank you, Mr. Chairman.
Committee, any further questions? Seeing none, you can continue, gentlemen.
Great. Thank you, Mr. Chairman. So what we'd like to do now is look at this concept of conformity as we move on to the next slide. And as Brian indicated at the beginning in his section talking about Kansas has a rolling conformity, so it automatically conforms to the federal tax code, and therefore any changes automatically flow through. So as we think about sort of from a macro basis, the Tax Cuts and Jobs Act, it was for the most part about a 10% cut in the overall business burden for businesses, the business tax burden. If we were to sort of look at the impact, and this is sort of highlighted in a study that the Council on State Taxation did with Ernst & Young, if we look at the impact on a state-by-state basis, and we just pull out Kansas, and we look at the sort of increase in taxes, and we'll talk about why in a second, you would have an 11% tax increase on businesses operating in Kansas, assuming nothing else changed. So why does that happen? So as we said, Kansas automatically conforms to the changes of the federal tax code. What Congress did, as we discussed prior, is it broadened out the tax base with eliminating certain deductions, adding this concept of a global minimum tax, but it also lowered the rate significantly. So what states were sort of having to grapple with and have been grappling with for the past, 3 years, almost 4 years, 3 years is what, especially states that have rolling conformity, is if we don't want to provide, impose a significant tax increase, where should we decouple or deconform to certain provisions, of the federal code? Because unless they decide to lower their rates, and look, we had states like Georgia decide to lower their rates, but many of the states decided that they were going to decouple from these provisions to make sure their bases weren't expanded to sort of therefore have a flow through of a tax increase. So as we move in and just talk a bit about the GILTI piece again, is just as a reminder, it was, Brian, if we just want to move to the slide 17, as a reminder, and as Brian indicated and walked through his example, really was put in place to act as this minimum tax, this, for lack of a better term, to protect sort of the U.S. tax base from companies, simply operating in low tax jurisdictions overseas. Not to discourage overseas investments, because, U.S. based companies benefit from having multinational operations, but to provide some level or some minimum tax. And it's important that those three elements exist: the base, the deduction, and the foreign tax credit, which the states don't have that element. So as we look at the multi-state sort of aspect, through the map that we've provided here, and this map has evolved over the years, so Iowa being the latest state to decouple. You can see states like Missouri, fully allow for a deduction of the GILTI. We have states like Nebraska and Colorado, which have their own unique way of providing some level of a deduction. But for the most part, Kansas and a couple of other states only, don't provide any deduction, so they're taxing the full effect of this GILTI, which, as Brian says, on a couple of levels. One, you're not providing a foreign tax rate or any credit for taxes paid in other states. Two, it seems to go against Kansas law with regard to the treatment of foreign earnings. So I think it's sort of appropriate that the bill that you have before you, Senate Bill 22, looks to bring Kansas more in line with the rest of the states from a multi-state perspective. So, Mr. Chairman, we've obviously gone through a lot of detail, and we focus more on the foreign piece. We know there's other elements in the bill. Happy to answer any questions with regard to the testimony that we just went through, or any other questions that the committee may have.
Committee questions? Representative Sawyer. Clayton, pardon me.
It's okay. I go by both. We're all good. So thank you very much for being here today. As I was looking at the state responses for GILTI, we tend to, Nebraska is a bordering state, and we tend to follow Utah on a fair amount of other policies, as we discussed yesterday. So I noticed that they had bills that were potential decoupling bills, and I was kind of curious. Obviously, I would understand if they didn't do it last year, given COVID, it kind of shut us all down. But were there attempts made prior to that in 2019, and how did that look in Utah and in Nebraska? Thank you.
Sure. Look, I think we all understand last year was a challenging year, as you indicated. Iowa was actually able to get its bill through. We know Nebraska is looking at legislation again this year. And those states are continuing to grapple with this issue as Kansas is. I don't know, Brian, if you have anything to add to that.
I don't. I don't know without looking whether those states had bills in that year. I would expect that they did. I just do not know that answer for sure.
Thank you. Mr. Chair, may I have a brief follow-up, please? Thinking about some of the changes that have taken place at the federal level and potential changes to any tax policy, let's say hypothetically we did pass this, but then there were more federal changes. What does, I mean, obviously we cannot predict what the federal government would do, because if we could, we'd be in a much better spot, right? But any sort of thoughts that you might have on potential federal changes given the turnover that has occurred there?
Sure. Yeah, these are no predictions, right? So, and just sort of looking at any potential changes or anything that's sort of been discussed at a very high level, it looks like, assuming a stimulus bill is passed sometime in the near future, that if the Biden administration decides to take on, let's say, tax changes as an opportunity to pay for certain items, it looks like those changes, the ones at least that have been discussed, are more focused on rate and not on base. And as we discussed, rate changes don't impact the states as you conform to the base changes. But look, it's hard. If the federal government for some reason were to change the base, you as a legislative body obviously would have that opportunity to, as you come back into session, to address those changes. But as of today, and anything that we've heard, through the campaign and now with the new Biden administration, all indications are they wouldn't be looking at base changes in this area.
Thank you, Mr. Chair.
Committee, further questions? Gentlemen, I had a question. First of all, the map is very telling. This last map that we had up here, I think it's page 18. How many total counties or total states are in the white that have a greater than 95% modification? Do you have that number?
I think we're at 21, but I can get that for you specifically. Apologize, I don't have that one off the top of my head.
Yeah, nor do I. Those that have the diagonal highlighting could also result in no. That just means that a special rule would apply such that you need to have a certain ownership percentage or something like that. Like Illinois, for example, I know is almost entirely a white state. So I did want to point those out as well.
And as we look at the rolling conformity, what are some of the disadvantages of decoupling partially from some of this code? What are some things that we should be aware of that we need to try to maybe counter? I know there's been some minimums put in, so I just want the committee to have a good understanding of what decoupling from that rolling conformity does exactly for Kansas and what we would need to do if we needed to put that back in place at some point if the Tax Cuts and Jobs Act were somehow repealed or changed drastically in the future.
Well, Ms. Chairman, let me take an attempt at answering your question, and I apologize if I missed this. It's my understanding this would be selective decoupling. So you're decoupling from specific provisions in the federal code. So you'd still conform to other broader changes or other code changes. So, for example, with regard to the specific section on guilty on 951A, if you decouple from that provision, and if it were changed for whatever reason in the future, you would certainly have the ability to go back and look at that.
Okay, thank you. Yes, that did answer the question.
Yeah.
Committee, do we have any further questions? Seeing none, gentlemen, thank you very much for your presentation as we begin to work through this very complex code. I'm sure we will always need resources, and we appreciate your willingness to come brief us today.
Well, thank you. We appreciate the opportunity.
Committee, we will now turn to our hearings. We will start out with House Bill 2104. And I will look to our lead reviser to give us an overview on House Bill 2104.
Thank you, Mr. Chairman. House Bill 2104 would amend the sales tax exemption. It would amend a current sales tax exemption found at 793606C. It wouldn't add a new one, it would just amend a current one. And this one currently exists for educational, or the exemption would provide for educational institution, but building materials, so it's kind of confusing how it was done, but currently the general sales tax exemption for purchases does not include the sales tax exemption for building materials. However, this bill would allow for qualifying educational institutions the sales tax exemption for these building materials, with the caveat in the event that the housing would not be inhabited by students of the educational institution. And with that, I'd be happy to stand for any questions.
Committee, questions for the reviser? Seeing none. Adam, thank you. And at this point, we will open it up to our proponent testimony. And I would call on Patrick Jonas, the CEO for the Cerebral Palsy Research Foundation of Kansas. Mr. Jonas, welcome to committee. Sir, I don't think your mic's on. There should be a button on the front.
Sorry about that. Thanks everyone for allowing me to provide testimony. I'll make it quick. You have a copy of the testimony, but just to summarize, Cerebral Palsy Research Foundation was founded in 1972. We provide a lot of different services for folks with disabilities, but one of the highlights was long before with the Americans with Disability Act, we started a housing project in partnership with HUD, Section 8202, that allowed persons with neurological and physical disabilities to live in accessible housing, and it was the first in the country of its kind. And what's happened over the years, 40 plus years later, is there's been a lot of foundational issues, structural issues with the apartments, and quite frankly, they're just too small. Back in the day, I used to work there when I was in college, you would push around manual chairs for folks and you didn't need the larger apartments, and these days everyone has a power wheelchair and a lot of them are kind of running into things. And so we talked to a number of the residents and asked them to help us design the ideal apartment, which they did. We had many focus groups. We brought that to an architect. The architect drew up some plans. We hired a contractor. We went and applied for our project exempt certification or certificate, and it was denied. And I was taken aback. We couldn't believe it because we've used it not for building projects or residential projects, but a lot of other projects in the past. So I called them and I said, what's the deal? And gal showed me this statute that says if you're building a building that is for human habitation, it can't be utilized. And that was news to us. And so I called a meeting with the Chief of Staff of the Department of Revenue and asked him if he knew what this was all about. And he says he thought it was meant for colleges and universities that build dormitories and apartments for students that are attending those schools versus an entity like ours, which is more of a research institute that is used, the residential facilities are for people with disabilities. Needless to say, he said that the statute is what it is, and unless that can be modified, we're kind of stuck. It was kind of interesting. We're building a congregate building right by our initial new 8-plex that was designed by the residents. The congregate building, when I filed an appeal, they'd allowed for the exemption for that, but they didn't for the building that's going to be a residential facility for the disabled. So that's why we're here, and we would greatly appreciate if you all would consider the amendment as presented. And there is a bit of urgency as we're already under contract, we're already building, we already missed one building, we have a few more to go, and the contractor's willing to hold his material purchases up till April 1st. So if there's any way that if we're fortunate to have this passed, that it could be in effect when it's published in the register versus the statute book, that'd be extremely helpful to us. So thank you. I'd be happy to stand for any questions.
Thank you, and I was looking to see if it was upon publication or Kansas Register, so that is a change that you would request.
Absolutely, if possible. Thank you.
Committee, any questions? Representative Gartner.
Thank you, Mr. Chairman. Thanks for being here. And I don't know, I evidently lost or didn't bring my timbers. Could you just verbally give us a quick overview of how many buildings you have? What's the time frame on the completion of all the building projects, et cetera?
Sure. The big picture is there's 14 buildings, but this first phase, we're only looking at 5. We actually tore down an old administration building and built a new 8-plex, which is going to be pretty unique because 2 of the apartments that are not going to be HUD related are for folks with disabilities that are younger. We've had multiple calls by parents asking, well, I'm not sure if my son or daughter is able to live on their own. Do you have a trial living area, which we didn't, but we're developing a program that would be 6 to 8 weeks and allow young adults to actually move in there and take classes. And it's kind of beside the point of your question, but I'm letting you know that's going to be a new initiative. But so the timeline is more than likely we're looking, because we've already started building, it'll be an additional 2 years before these first 5 buildings, basically a third of the project is complete. And the rest of the project is going to be dependent on the possibility of capturing some federal dollars in fundraising activities, and it could be 5, 10 years out.
Representative, that answer your question? Okay. Any further questions, committee? Representative Sanders.
Thank you, Mr. Chairman. Mr. Jonas, does any educational activity whatsoever go on at the Timbers?
At the Timbers, outside of training, informal training, no. Most of the educational activity goes on. We have a computer lab for persons with disabilities. We also have a number of research projects, and it initiated with a project we had for 25 years with Wichita State University. It was a Rehabilitation Engineering Research Institute.
So are those buildings included in the current project?
They are not. This is just the residential facility.
Further questions, committee? Seeing none, thank you for your testimony, sir.
Thank you very much.
Committee, we also have written testimony from Matt Fletcher, Executive Director from Interhab. I do not have anyone listed as neutral or opponent testimony. Is there anyone else wanting to appear to provide testimony? Seeing none, we will close the hearing on House Bill 2104. And we will open up the hearing on House Bill 2106. And again, I would turn to Adam Siebers to provide us a brief overview.
Thank you, Mr. Chairman. House Bill 2106 deals with the timeframe when corporations are required to file their income tax returns. Currently, the deadline for filing corporate income tax returns is April 15th. This deadline would be extended. This would be for, of course, state income taxes. Under the bill, corporations may file their return 1 month after filing their federal income tax return, and this would include any extensions they would receive. There would be no penalties if the corporation received an extension to file a return with the IRS, and then the taxpayer would not be required to file an extension with KDOR if they get an IRS extension. With that, I'd be happy to answer any questions.
Thank you. Committee, any questions for our revisor? Seeing none, thank you, Adam. Our first proponent for House Bill 2106. Oh, I had those mixed up. I apologize. Kent Eccles with the Kansas Chamber providing oral testimony. Welcome to committee, Kent.
Live. going? There we go. Good afternoon, Mr. Chairman, members of the committee. I am Kent Eccles here on behalf of the Kansas Chamber. Appreciate the opportunity to appear briefly today in support of 2106. And I will be very brief because this is a pretty simple bill. It extends the deadline for filing corporate tax returns to 30 days after the federal extension deadline, which is October 15th. So why are we here asking for you all to do this? And what's the need? The Council of State Taxation, which you heard in the GILTI presentation earlier, since 2009, they've been recommending that states that have the same October 15th federal extension as the feds do, and you'll see testimony in your packet from cost on this too, from Fred Nicely, if you need to go into more detail. But as a result of the 2017 Federal Tax Cuts and Job Act that changed the federal extension to October 15th, which Kansas already had as October 15th, that's put a burden not only on taxpayers, because Kansas tax returns are based on their federal tax returns. So if they're due at the same time, it causes a lot of compliance issues and it complicates them when they file those at the state level. So it would be great, it would be taxpayer friendly if filers in Kansas had an extra 30 days to do that, and that's what cost recommends. And that's one benefit. The other benefit is that it would also ease the administrative burden on the Kansas Department of Revenue, because they would have less extension requests, they'd have to process less, penalties and those kind of things. So it'd be a win for taxpayers and a win for the Kansas Department of Revenue. So that's it in a nutshell. I'll stand for questions now, or I don't know how many other proponents or whoever else you have. I'll be here.
You are the Lone Ranger today. So.
Okay, I wasn't sure. I know we've talked to the Department of Revenue about it. They seem to be okay with it. I didn't know if they were going to weigh in. That's why I said that. So.
Okay. Yes, committee, any questions for Mr. Eccles? I do have one. You referenced that the Tax Cuts and Jobs Act changed this date. Did we have that 30-day extension prior to that? No. No. So we had a similar or a concurrent deadline at that time?
Yeah, the state's extension was already at October 15th. The federal extension. The feds matched it, and now our taxpayers in the state of Kansas are like, well, this is kind of tricky because we file our federal taxes and our state return, and you heard some of that in the presentation today about GILTI and all the apportionment, companies that have operations in many states, they have to combine their reporting and boil it down to Kansas, and giving them 30 days to do that would be a big benefit to them.
Okay. See. Committee, any further questions? Seeing none in the room or on the computer, thank you for your testimony. Kathleen Smith with Kansas Department of Revenue is also online. I didn't know if does the department want to weigh in on 2106? Is there anything to add?
Mr. Chairman, this is Kathleen Smith with the Department of Revenue. The only thing that I would add is we have extended the deadlines for the Kansas corporate income tax returns for the last 3 years based upon this request from cost. So we have done it for the 17, 18, and 19 returns, just for your information.
Okay, thank you. Committee, any questions for Kathleen while she's here? Representative Highland.
Thank you, Mr. Chairman. So would this better be handled as a rules and regulation change or as a statute change?
I think from the Department of Revenue standpoint, it would probably be better be handled within the statute.
Thank you, Kathleen. I'm not seeing any further questions, so thank you for that. Committee, we also have proponent testimony from Fred Nicely with the Council on State Taxation in your packet. And committee, I have no proponents or neutral testimony. Is there anyone wishing to appear before the committee? Seeing none, we will close the hearing on House Bill 2106. And committee, that does finish our business for today. We wrapped up a lot quicker than yesterday.